Welcome to module number 5, fundamental analysis. This for me is one of the most interesting parts of trading and probably the reason why I've stayed in this game for so long. It is the dissemination of information that comes out, that flows around the world every day, and then taking that information and then applying it to market prices to see whether or not the price is going to go up or down. And it's part of the reason why I've set the core markets as capital, money, energy, the means to get anything done, and food, because they affect us all day, every day in our lives. So information comes out, it very much starts, even reading the weekend papers when I'm relaxing, I'm flicking through them and seeing what can affect the prices of the assets that I trade and even the assets that I don't trade. I'll read something and go, well, that's going to affect the price of X. And I'll go and search that asset out and see if it is going to move based on that information and random information I've read in the paper at the weekend. This is the sort of passion that I have for fundamental analysis and how interesting I find it. And hopefully, with a little bit of explanation and understanding after this module, you'll get bitten by the same bug. And even if you don't go on to be a trader, you'll have that understanding of what moves markets. Okay, so enjoy the module. See you on the other side. Fundamental analysis, module number 5 of this foundation series. So this is going to look at what moves markets. So prices, they move because information changes expectations. And there's a lot of information in this world. We have 2 types of information. We talk about fundamental analysis. Quantitative. This is economic data. Things like earnings for your company reports and trading single stocks. Big data, inflation, GDP. So inflation is the rate at which prices either move up or down in an economy or around the world. And this is a key gauge for central bankers and those making decisions and politicians that have a huge knock-on for the value of markets, essentially, because economies are run, it's kind of Keynesian economic theory for the past 100-odd years, and countries want moderate inflation, they want good GDP, they want low unemployment. Those are the key things that judge an economy's health. Okay, so any deviation in inflation, up or down, GDP up or down, is going to have a huge knock-on effect to policymakers and all the market. We'll discuss that in a bit, but we find out these clues through economic data, which is published every month. So you have a series of, we call them figures, the figures that come out every month, and these give us an idea of how the world economy and specific countries are doing. So then we can base trades on that, and the markets move based on that. It's the same with earnings and any sort of quantitative data that you get for companies, and that will move the price of those companies also. And then you have the qualitative stuff. This can be a tiny bit more ambiguous, and whereas the quantitative data is generally, say, 95% of the time structured and put in a calendar. Qualitative, although can be structured in a calendar with who's speaking and when, can come out of nowhere. You can have central bankers. These are the people that make the big decisions about interest rates, which rule the world, essentially, which is kind of the access or not to money. So these guys and girls can speak whenever they want, but sometimes they are structured to speak, and they could say something like, we think rates need to go up, or we think rates need to go down, and this can dramatically affect every market. You've got the political shifts. I mean, the political horizon is always volatile, really. I don't think there's been a period of calm in politics that have calmed the markets for a long time, and I don't see it coming anytime soon. We have Trump in charge over in America, and a lot of kind of what he says will move the markets a lot, and you don't know when he's going to say it. It used to be, there was a time when I first started trading, your presidents, your prime ministers, and your leaders of the countries wouldn't affect markets as much as they do now, but they're very much involved in the markets and the kind of day-to-day trade around the world that then has a knock-on effect to commodities, financial markets, food markets. It's all very much interlinked now. You have corporate guidance coming from those who work in companies and those who are kind of watchers and analysts of companies. You have a lot of this qualitative guidance and thoughts around companies coming out that can very much move markets. Same from there's a term in crypto, key opinion leaders, calls. These people have huge influence in the crypto market, but you see these calls in TradFi as well in traditional markets, affecting the price of assets. And obviously, geopolitical developments. We touched on political shifts, the ever-changing geopolitical environment between countries doing business with one another, and the flow of trade, and even things like we had the pandemic that really affected markets. You could say that's a geopolitical development mixed with a natural disaster. And that's another thing that's not in there, which has to have a special mention, is anything can happen in the world in a natural disaster kind of once in a lifetime event. These are called black swan events. There's a very good book called The Black Swans that's worth a look, that talks about this. Anything can happen at any time, essentially, when you look at it from a qualitative perspective. This information matters because markets move when expectations change. If we're living in a world where we think, the world's going well, interest rates should be going up when we have growth and economies are stable, but then something happens. Commentators come out, central bankers come out and say, no, we think that the horizon's going to change in the short term, and we need to move from a less hawkish stance. Hawkish is raising rates, to a more dovish stance, which is reducing rates. And then you're moving on to like growth expectations. Same thing goes there. We have growth projections year after year that central bankers feed to governments, and decisions are made on these, 2-3 year plans. But these get reviewed regularly by independent bodies, by the central banks themselves. And if these change, then there could be a full change in policy moving forward, which then has a knock-on effect onto prices of certain assets. Likewise for inflation, you can get inflation shocks, as we saw after the COVID pandemic, when a lot of money was injected into the system. This pushed prices up, and then there was a huge knock-on effect to policy. Interest rates had to go up to curb these, to reduce the flow of money. I explain all this more deeper into the course, but you see inflation, growth, interest rates come up a lot. These are the core things that move markets and control decisions made around the world in the world economy. Supply or demand expectations in all commodities move the markets. I mean, this is a very economics 101 lesson on supply and demand. If you increase the supply of an asset, the price should go down. If you increase the demand of an asset, the price should go up, and vice versa. Decrease supply, price goes up. Lower demand, price goes down. Very simple stuff. And anything that affects those supply or demand dynamics is going to then have a knock-on effect to the price. Expectations versus reality. So you've got to digest the information. It's not the data that moves the markets. It's the difference between expectation and outcome. And this goes for quantitative and qualitative. All the quantitative data has a estimate of what it should be, earnings, monthly figures, output, inflation, GDP, they all have an estimate. So the market price is in that estimate. Likewise, if a central banker, they're hawkish, they're always talking about putting rates up, that's priced into the market. If that data then comes in different, so inflation was expected to be 2% and it came in at 3%, it's a lot higher than the market expected. So then that has to be priced in. Likewise, your central banker, he's coming out, he's hawkish. Everyone knows he's talking. This guy's going to be talking about his rates going up. If he suddenly says, no, I think rates need to go down now, the market is going to have to price that in. And that's the expectation and the outcome, the reality of using fundamental data to trade. Market reacts in phases. You have the immediate reaction to the fundamental information coming out, which is short term. Then you have a big digest, interpretation and positioning over the medium term. Is it big enough to move the general direction in the medium term? And then a repricing over time, which is the long term. These are the three durations that I use a lot, short, medium, and long term. And you have to factor all of this in when you get the information. As a professional, we interpret the quality of the information, so the credibility of the source. There's a lot of fake news out there. I mean, it's a buzzword, and it's going to be a buzzword for a long time now. The advent of AI and various other platforms pushing out info that is a bit dubious. So credibility of source, the speed of dissemination is getting that information, and are you getting it quick enough to then trade on the short term, or do you need to look more of a medium and long term? Market positioning as that data comes out. If the markets, if you're getting real positive information and the stock market's at highs or a stock price is at highs, is that market got much room to move, or is vice versa? If it's really high and you get some bad news, it will have a lot of room to move lower, for example. So where the market is at the time of that information. If you're at highs and you're getting bullish information to move it higher, perhaps it won't go as far as if it's at highs and you get bearish information and the price should go down. Always one to consider. Also, liquidity conditions. Are you getting this information and it's in a tradable market in sound liquid conditions, or has liquidity been reduced because the market knows the big data is coming out and they don't want to be caught with a position on? Okay, that's very important to understand liquidity conditions when the data comes out. This is all based around the efficient market hypothesis, fundamental trading. I've kind of alluded to it. This is Eugene Fama came up with this theory in the 70s where markets reflect all known information at that time. So when new information comes out, the market then has to reprice that asset. But it doesn't always do it perfectly. Okay, so there's another great book called Efficiently Inefficient, where the markets actually do run efficiently, but have spates of inefficiency where markets can go too far, for example, and overextend. And this creates a lot of opportunity, essentially, both sides, being efficient and inefficient. And understanding when these things happen and how they happen puts you one step closer to your trading goals. Okay, some non-negotiables for us professionals. Preparing for known events. There's no excuse if you have a trading calendar, an economic calendar, and you understand when all these events are happening. No excuse not being prepared and knowing that these events are coming out. Understanding the wider macro picture, what's going on in the world markets, what's moving, what people are saying. You get a general feel of the markets, if they're bullish, bearish, hawkish, dovish. Understanding that is very important. Avoiding those emotional reactions to these bits of data, trying to chase markets when data comes out, or getting caught in the chop of prices that when the market reacts to data. it can be very emotional itself, and then you trying to conduct yourself in that emotional market that's trying to understand and digest that data, you can get yourself what we call chopped up. You get in and out, but you're just buying and selling and stopping out, etc. And you've got to have a plan, remove the emotion, and execute that plan. So that's part of that interpret rather than chase the market, is what I was trying to tell you there. Digest the information yourself, have a plan, trade or don't trade. And always be prepared for change. The markets can be, I've seen this so much in my trader life, that markets can be so solidly one way, and you think, wow, this is never going to turn around, this is never going to change. And then bang, something happens, and then it flips around. I mean, what's happened recently? Cocoa, for example, we were at $12,000 in the futures market for the price of cocoa, and then you just think, wow, when's this ever going to come back? There's shortages in the Ivory Coast and Ghana, bad weather. When's this ever going to change? But it has. 18 months later, it's 3,500, and it's come all the way back to kind of the tradable range where it's been trading for years. So things can change. Always be prepared for that change. The key takeaway is, do you know what information moves the market you like? So that was fundamental analysis. What moves markets? The information that is out there, flowing around the world, affecting prices up and down, and giving the most amount of opportunity that I've ever seen in the markets. The information flow is greater than ever. Markets are more sensitive to information flows more than ever. There's more micro black swan events that you don't see coming, that happen, that affect these market prices. And the interconnectivity of the world markets is more than it's ever been. And this is all only going to grow. So fundamental information and fundamental data and fundamental analysis is a cornerstone of what you need to do to succeed in the markets. You've got to have a grasp on that fundamental analysis. I find it super interesting. Hopefully you'll find it super interesting, and it will help you on your journey to become a successful trader and have that sustainable, disciplined relationship with the markets. And you can't have that without understanding the fundamentals of what drives market prices. Okay? Thanks for watching, and I'll see you on the next module, hopefully. Take care.